I need some traction. You need some traction.
Hey everyone, Lloyd Lobo here, co-founder at Boast AI and Traction. Today's Traction session is brought to you by Boast AI Launch Academy in partnership with Growth Blazers. Folks, as you're joining, feel free to introduce yourself, where in the world you're tuning in from, and what you're looking to get out of the session. You can just click the to everyone, not hosts and panelists, click to everyone and introduce yourself. I am tuning in from the Bay Area, and Alex here is tuning in from Brazil. So feel free to introduce yourself, where you're tuning in from, what you're looking to get out of this session, what does your company do. Super exciting topic today. Despite the COVID and the pandemic taking over the world, companies across the US and Canada managed to raise over 250 billion. And founders now have various financing options, from raising from the plethora of micro VCs and solo VCs like Elad Gil to traditional PE firms or hedge funds like Tiger Global. I think in 2021, they funded over 400 companies en masse, and then non-dilutive capital from companies like Pipe or CapChase or Clearco to R&D tax credits like we do at Boast. So we're going to talk all about it, like what are the disruptions coming out in the funding landscape. Couldn't find a better speaker on the topic. Alex Bangash here is considered the VC maker, the fund maker of Silicon Valley. He's invested in some awesome companies, awesome funds like SaaStr, like Atomic VC, Initialized Capital. He's made some of the biggest or most successful VC firms of this decade, investing over $2 billion in more than 50 funds. Like I said, Initialized Capital, SaaStr Fund, Atomic VC, Heavybit, you name it. Alex, welcome to Traction. How are you?
Thank you so much for having me, Lloyd. Yeah, I'm really excited to talk to your community. You've built such an awesome community of founders. Super excited to talk about the funding landscape, especially now as we'll talk about it. Funding is not just something that a founder does at one point. It's inexorably connected to their journey. So thank you for giving me the opportunity.
Definitely. And people from all over, from San Diego to Ottawa to Montreal to Bay Area to Germany to Maryland, Los Angeles. This is great community here tuning in, almost 100 people. We got over 300 people registered. So let's dive right in. You've had a super successful career in VC. You're effectively the VC maker of Silicon Valley. Give us your backstory. How did you get to where you are today?
Yeah, so maybe I can tell you just a little about kind of myself. So I am I'm an outsider. I would say I'm almost like a double outsider. I studied computer science. After I came to the US and studied computer science, and while I was an engineer, I had a couple of ideas. I had an e-commerce idea, then I started an optical networking company, and most people don't realize. But it's not about the quality of your ideas. It's about the intersection of the market and the idea, right? And some of these markets just went away, like optical networking as a market, like almost went away in the year 2000. And I had this epiphany. I was like, maybe it's better to be an investor and allocate across different markets. And so I was in business school at that time, and I interviewed with some VC firms, and they said, "Look, Alex, we're not investing. Why don't you? We're on a hiatus. Why don't you talk to some limited partners on what this industry is going to be like?" And so I went and I spoke with a few limited partners, and I found out that a lot of them were just following the crowd. It's like, it's like, how do you pick a manager? Who do you invest? Well, we see who else has invested in XYZ. And I thought with my operating experience, I could have a different viewpoint. So I basically convinced a few people to hire me like a scout. And the funny thing is, Lloyd, you will like this, that a lot of times they said, Alex, we really don't believe in your ideas. Just find us what the smart people are doing. And this is like a Yale endowment or a Harvard endowment or a Stanford endowment. So I would go to their conferences. In one of those conferences, I saw these VCs speaking. And I will not name the VCs, but this is the best VCs at that time. They were speaking, and then there was a young guy speaking, and he literally looked like he was 19 years old. And this is, by the way, 2005, November of 2005. And that young guy was at that time they were talking about viral marketing. Now, of course, viral marketing is nothing new, but in 2005, it was very, it was kind of very novel. And so I went up to him and I said, look, how come, you're younger than all these great VCs, but you're on a different plane. And so the person said, look, that's because I'm an operator. These other guys are investors. So I asked them. I said, can I be investor with you? So that. He said, sure, why don't you come visit with us? So, over the next 2 years, I kept visiting. And then I told my investors, I said, you know what, we should put everything you have into this investor. And they said, Alex, you are crazy. This fund, their best company is Facebook. Facebook has 10 million users and is unprofitable, has no revenue. MySpace at that time had 65 million users, was profitable. That person was Ken Howry. That fund was Founders Fund, and that's kind of the Founder Fund story. So there's a story like that with and my friend Gary Tan and and others. But yeah, that was the Founder Fund story and how I first found Founders Fund. And why actually our clients ended up become a major investors in the first one.
So tell us what TI platform is today. Like, give us the sort of pitch of TI platform.
So TI platform is very different. People try to think the way I would like to think about, and we'll talk about this. So many of your audience are operators and founders. And these operators and founders used to they would just take funding, and then they would fund, and sometimes they would take fundings from seed funds or late stage funds or VCs. Today, as that funding has democratized, these founders can work with institutional investors throughout their journey. And so I've created like a new platform which can be not just a capital partner, but a thought partner for these founders. So literally, founders can start funds with us. Founders can, just like Jason and Gary and others started funds with us. And then they can start companies with us. This year, 7 founders and counting have started companies, or at the very stage they can start, and they can also start, very ambitious projects. Another thing that we're involved with is like Entrepreneur First. Entrepreneur First will build thousands of companies globally, and it's is it a fund, is it a company, is it both? I think it's almost like the fifth industrial revolution, right? This is now startup formation at scale, and so we are very, very lucky to be capital partners and thought partners for these factories of startups.
Definitely.
to incubation models, to founders, who are doing very exciting things. So yeah, that's what we're doing. We're just a new source of flexible things to help founders build companies. And we've also invested in companies. So this year, for instance, this is all public information, but we invested in Truepill. We lit the Series B there a couple of years ago. It's a massive company, the leader in healthcare. We invested in Standard Cognition, Drip Capital, and many others. So they're all they're all children of ours. So I don't want to play favoritism.
Yeah, so you're investing directly in startups, you're investing in funds, you're also funding entrepreneurs with communities that has access to deal flow. So it's a widespread model here. So let's dive in, to some of the topics for today. What do you see are the key disruptions in the VC and funding landscape today?
It's great. Well, thank you so much for saying that. So I think what has happened is, and this is even in the last last kind of decade or so. If those of you who kind of read, VC was this asset class which was very small. It was rarefied. It was boutique. It was artisanal. If you see Phil Knight's thing in Shoe Dog, he could not get VC money. VC money was only available in Silicon Valley. It wasn't in Oregon. Or Sam Walton could not get VC money, and VC money, you could only get VC money from the likes of a Sequoia or an Excel or thing. So in a lot of cases, in the last 50 years, up to say the last 2 or 3 years, VC was an access class. So it wasn't an asset class, it was an access class. Now, all of a sudden, this year with Tiger and these multi-stage funds, you alluded to, that is no longer true. VC is no longer an access class. Today, everybody is a VC. Hedge funds and public equity funds like Franklin Templeton, they're coming down. Hedge funds like D1 and Viking and Core2 and of course, Tiger. There comes founders. Founders are VCs throughout their journey. They even before they start, they can operate scouts as operators, and then they will be angels with rolling funds, and they will be even running public companies with side funds. So we backed Girish Mathrubootham, who's the founder of Freshworks, the most iconic SaaS founder out of India, and he has a VC fund. Every founder in SaaS founder especially in India wants to work with Girish. So it's just so all of a sudden this access class is no longer an access class. And of course you alluded to Pipe and Clearco and there are other sources of capital. Now that's one side that you're seeing, right? So in some sense, what has happened is it's almost like the curation. The analogy would be the curation of content, right? 15 years ago or 20 years ago, if you wanted to see anything quality, you would have to switch on NBC or HBO. Now you can see quality stuff anywhere, right? You can find great stuff on YouTube, or you can, you don't have to go to a JP Morgan or Goldman Sachs event to find quality content. You can find it on Lloyd Lobo's video log and podcast, so amazing people like Jeff Lawson. So it's democratized access to great content, but also democratize access to great startups. And there are these many touch points. Now the flip side of all that is is that the big Sequoias of the world, you saw this big announcement. Sequoia said that they will move to a permanent capital structure to hold public stocks. So, so when this tells you that the most famous, well-regarded VC is now becoming a public equity manager, these lines are blurring, right? So there's the tigerization of funding. Tiger did this, but it's like, Sequoia and everyone going to public equities, and hedge funds going down.
What does that mean though? Public, whatever Sequoia is doing, for our audience maybe that may not be too familiar, what specifically does that
Well,
mechanics look like?
What that means is, I mean, this is like, it's like, famously, and I'm not going to pick on Sequoia, I'm just talk generally, when you take money from a VC fund, that money is not there forever. They want you to get an exit, and that exit is in 7 to 10 years. If they've invested, or maybe, if they've, just so so if they've invested in year 1, then at best you have 10 to 12 years. If they've invested in year 3 or 4, then typically they want you to give them some of their money back in 8 or 9 years.
Sequoia, explain like what Sequoia is trying to do and what does that mean for everybody?
Yeah, so I think so as you know, typically what a fund is like a 10 to 12 year old vehicle. So the 10 to 12 year old vehicle is so VC funds will invest for 2 to 3 years, and then they will harvest the next 8 to 12 years. And so what happened was is most of your audience knows is that your venture funds need an exit. And in this case, what has happened is that that Sequoia has said, look, and it's not just Sequoia, it's like funds like Tiger. Tiger will, as you probably heard, Tiger or a Coatue, or they will keep public securities. And sometimes the biggest appreciation, again, I don't know the exact appreciation, but a Shopify maybe went up from a $2 or $3 billion company to $100 billion plus company. Similarly with things. So sometimes a lot of the appreciation happens in the public side. So these venture funds are now saying, why should we keep the companies just when they're private? Now, having done that, they are now becoming hybrid managers. Now, that's all good, but then the distinction between the Sequoias and Tigers and Coatues is diminishing. These hedge funds are investing early stage, and the venture managers want to keep these securities in the public markets, which could be good for it's not necessarily good or bad. It just changes the flavor of those firms, right? So now think of it. We'll talk about some of these things. If some firm is their largest position is 1 billion or 10 billion, and they're giving you $5 million, obviously they're going to be less concerned with the $5 million position or the $500,000 position than they're going to be with their $10 billion position. So that's the change that's coming into the thing, and that's the visible change. The other change, which is kind of the subtext of all this, and which your audience probably doesn't see, right? So this is the stuff you can read about. This is the stuff you're not seeing is the investors in those funds. So the investors in a D1 or a Coatue or a Viking or a Sequoia in Tiger, the investors of those funds are now saying, you know what? These funds are so big, right? They'll keep investing with them. But they are saying, okay, venture is such an important part of their asset class. If you look at the top endowment foundations, the kind of the Yale universities of the world and stuff, up to 30 to 40% of their assets are in venture. So they're saying, well, if so much of our, it's not public equities that they're holding, it's tech, it's not hedge funds, it's technology. And so they are investing directly now. And this is kind of almost like a direct to startup model from the demand side. So how on the consumer you have direct to consumer models, right? And so now in institutional capital world, there is a direct to startup model. And so most founders are not aware of this. They don't know this is happening, right? Because today it's just happening with the biggest companies on the planet, like Coinbase and in TalkDesk and things of that sort. Really kind of things, but it's slowly trickling down. These institutional investors, the investors of the venture funds, are now investing, and as early as seed. Of course, they will not lead seed rounds, but they are investing in series A's, B's, C's, D's. And that is like that is probably the most profound change that has happened.
So with this direct to startup model, how do startups access? Because a lot of the questions here are, how do we connect with investors, right? So how do they get access? How do they contact them? What are some best practice for getting in touch with VCs, especially at the seed and Series A stages?
That's a very, very good question. And I have to tell you, for the longest time, I used to, talk to founders, and, I would sometimes, before we invested, I would talk to the really prominent founders, and they will say, well, Alex, I am heads down. I do not have time for my investor. I just want to. And then, 3 years later, they would call me, like, Alex, I'm raising a fund. Is there any chance I can meet some of those investors? I was like, you had a chance 3 years ago if you had just given them 15 minutes of your time. So what is the beautiful thing that's happening is that today the founder journey, is kind of connected with investing. So these founders need to, they don't just start as investors. They even before many founders start their companies, when they're operators, those that start as operators, they will be scouts. When they are, they will apply to incubators, they will set up their funds, and so they have chance of connecting with those same investors, who will then things and look, you're talking to one of them, right? So I am one of those things, and then it's the community that we've built. So we are also, just like you've built an amazing community which is supportive. It supports your business, it supports other business, and so this is the same. The same thing that we are doing is allows the founders to connect with those people that will not only support them, but also support them in different models. They will support their fund. They could support them. They could support multiple companies. If they want to build a studio and want to build multiple companies, it will support their. It could support their. If they want to incubate a company on the side. And that's the thing. So increasingly, and that also creates like the supply side of this direct to startup, right? So I wish I could tell you that that it's X, Y, and Z. It's not just a name. It's like it's the same people. It's today the venture funds are investing in those people. The tigers of the world are investing in those people. The traditional VC funds are investing. one VC fund, not to be named, has invested in 2,200 other VC funds. Now, whether the partners have invested or they've invested, another VC fund just closed. I think they said, oh, we're going to invest in 50 of these, solo GPs or angel funds. So that's kind of what's happening. And it's, so it's, I would see it as a continuum, rather than like a abrupt change. So
with like the tigerization of capital, as you said, or democratization of capital, so much capital in the market, I think Tiger's thesis is that the software asset class is undervalued, and that's why they're investing at a high pace. And so more and more founders are going to launch side funds. There is the capital for them to access, because as founders, as good founders, they either have communities or they know other people giving them access to deal flow. So this is great. Now I want to go into sort of the market right now and how founders should think about fundraising and valuations. And then I want to go into sort of how to raise a fund on the side. So the first thing is, like, the valuations are crazy. I don't even know how companies or VC funds are affording to pay such premiums, especially like a Tiger. So how should founders think about fundraising and valuations in this environment?
It all has to do with supply and demand, right? Just if you look at the amount of supply, just sheer numbers. This is Economist just did a survey. So today there is actually 4 times as much capital from hybrid and non-traditional investors as there is from venture. So there is so much capital, and that's why you can, it's the tiger, not just the tigers of the world, but corporate VCs and family offices and others who can, and they're paying really, really crazy prices. And don't even get me started on crypto. I'm a crypto believer, but not every exchange is going to be Coinbase is doing billions in transactions. Now exchanges doing tens of millions in transactions are not going to be worth tens of billions of dollars. And people say, no, this time it's different. Well, it actually may not be. What people forget is, if you look at E-Trade, E-Trade went public in 1999 at 44 billion valuation, and then it took 20 years to almost get acquired for like a very, very small amount. 1/20th of the price it went public at. I think there is a lot of E-Trades. You've seen Casper. So there's a lot of those type of companies in the things. And it's not that the companies necessarily are bad. It's just supply demand. Look, it took Cisco, it took Cisco 20 years to achieve the valuation it had in March 2000. Right, and Cisco was the most innovative, well-run company, of Web 1.0, and it wasn't like, telecommunications went anywhere, right? So it's just, so I think there's going to be, so I think, from a founder's perspective, it's a great time to be fundraising, but it also means that, and this will probably continue, but it also means that they need to be really cognizant of what they want. Today, if you look at, these are just numbers that were published in PitchBook. In the last 10 years, the round size, the Series D round size is up 5x. The Series D is up 11x. This is the median round size is up. Just you can see. Whereas this is the round size, and then the actual I would say the round the post money valuation, the Series D post money valuation in the last 10 years is up 30x. For Series C, it's up 10x, right? So yeah, these valuations are crazy. And so I think founders need to just see who they want as partners. And I have often talked to founders, many founders are like, they want some sort of prestige, they want like, I want XYZ, I want this brand or that brand. And, at the end of the day, a lot of, I'm not saying there's anything wrong with the brands or something. A lot of these people are dopamine fiends. They're chasing you, right? And you don't want fair weather friends. You want people who will be with you through your darkest times, right? I mean, when Gary Tan he helped Coinbase with their Series A presentation, Coinbase wasn't the hottest startup. It was like, why do Bitcoin? When Jason Lemkin took a bet on Thiago Pieva, it wasn't like, contact center was the biggest market. The biggest company in contact center was $150 million. So it's like, who is your true believer? And you need to find your true believers. And I think that's so much more important than finding fair weather friends, finding the kind of finding the dopamine things, So I always remind myself, and a lot of times, we all are influenced by media. It's like, oh, well, this person is on the Midas list, or this person has all these awards. Tolstoy was nominated for the Nobel Prize for literature for 5 times. He never won. 2 times for literature, for peace, he never won. Peter O'Toole was never won an Academy Award. Paul Graham and Jessica Livingston were never on the Midas list. The investor and incubator of Snowflake, Mike Spicer, till Snowflake went public, he was never on the Midas list. So you need to find the Gary Tans, the Jason Lemkins, the Matt Cliffords, the Mike Spicers of the whole world who are hiding in plain sight, and work with them. Not the shiny VCs who will give you money and not help you.
Go off, date or marry those who love you more than you love them. Basically, optimize for the relationship versus the transaction. Because if you sort of optimize for the transaction, there's a big roadblock. Either they're out of there or you're out of there. So that's good advice. I'm trying to understand here, dive a little deeper. What are some metrics that are driving valuations these days? Is it still your growth rate, your net revenue retention, your gross margin? What sort of, to get that 20, 30, 40x valuation, what numbers are you seeing at seed, Series A, and Series B?
And this is no disrespect to all the smart people, the quantitative people. I'll tell you the biggest metric, and the biggest thing, it's actually greed and FOMO. A company that that's going to be the new Bank of India is profitable, and it's amazing. They will build a $10-20 billion company, and it's like, yeah, people are just going after things that don't have a business model. Why? Because everybody else is going after things that don't have a business model. So actually having a business model and being profitable is bad, because if you didn't have a business model, you could be valued more. It's the same thing. So and of course I also want to look, I've been giving a lot of generalities on the fundraising side. I also want to mention that there are also some things now that you can take money from everybody. I'll also tell you, it's also probably not good to take money at every stage from everybody. So if you're, for instance, if you're doing your seed rounds, most people, I've seen a lot of founders, they're like, oh, I'm doing my seed round and I got money from this $10 billion fund. And I was like, oh my God, you didn't do that. Why? Because that $10 billion fund you are a portfolio bet for them. So if they have, they're basically playing money ball. So if they bought 10 or 20% of your company for $1 million to $5 million, they're never going to invest 100 million or $1 billion, right? So in some sense, when you're, don't take big money from, don't take big money from small funds at early stage, and don't take small money from big funds at early stage. So yeah, there are a lot of these fundraising pitfalls that early stage founders can get into. So
you said greed and FOMO. How does one sort of manufacture greed and FOMO so all the VCs are knocking at their door?
Yeah, but it's again, some people are very good at manufacturing greed and FOMO, right? So hey, WeWork was, WeWork could have built a big business, but WeWork built more of greed and FOMO than they built the business. So the question is that the best thing to do in the long term, right? So I think when I look at things like Zapier, I think we have 3 or 4 companies in our portfolio that are like Zapier. They're like anywhere from 10 to 20 million in revenue, in some cases 60 million, and they're profitable. One company is doing 60 million with 20 million in profit this year. And yeah, they're growing 15% or 20% a month. They will never raise more money. There are other SaaS companies, they will just, one company in our portfolio might go public after having raised a seed round at 35 million. So the question is, does it matter that they never raised money? So I think you want, so yeah, the greed and FOMO is, you can create them. Sometimes it's just market. I think a lot of times we give too much credit. Of course, there's some founders that are very charismatic and they can play off VCs one against the other, but it's also the particular dynamic of a market, right? Look, lending was hot and then it wasn't. Buy now, pay later is hot now. Maybe it's not going to be, right? So neobanks were not hot, and now they're hard. So it just goes in cycles. Some sectors will become very, very hot, and then they will become cold. They might come back, and of course you see the boom and bust in crypto. Also, look at the ICOs, right? Most of the ICOs that came out in 2017 that were so hot didn't do well, right? So yeah, they created FOMO, but they're not enduring, right? It's a different set of layer ones and NFTs and marketplaces, but the people that created FOMO could not create enduring businesses.
Definitely. Ultimately, the fundamentals of business always work, and what has been driving in the past is like, hey, are you growing 2-3x year over year? Do you have over 100% net revenue retention? Do you have north of 80% plus gross margin? And then you can command what you want eventually. But how does one connect with investors? What are some best practices you've seen? How are the best founders connecting? Is it, Jason Lemkin is famous for taking cold emails, but a lot of people say don't do that, like get warm intros. What are some hacks you recommend?
I only invest in relationships, so I think COVID has been really hard for me. So it all depends. Certain people, certain investors, they've already made a market map, right? So in fact, many founders think that investors are investing in you and your company. Actually, they're investing in the market. They're not investing in you, they're investing in the market. That's why Tiger will invest in you, your 5 competitors, and the seed funds that funded you, because it's the market. If the market does well, everything's going to do well, right? If the market does poorly right now, if you're in cloud infrastructure, you're doing great. It doesn't matter what type of cloud infrastructure it is. Cloud infrastructure is doing great. Crypto is doing great. So it's the kind of the rising tide. Now, that is one of the things. So it's like, can you be in the hot market? Now, if you're in the hot market, if you're in embedded finance, if you're in crypto, if you're in something else, the flip side is building relationships. I think the network is very, very important. So no matter where you are, you're part of a network. If you didn't go to college, or you're one of those exceptional people that dropped out, you're part of a network of a Y Combinator or an entrepreneur first. You're part of the SaaStr community, or the Boast AI community, right? So it's like, wherever you can find a community, you're part of a developer community, right? An open source community. So I think today, because we are in this connected world, you can have a transference of trust. At the end of the day, the really substantive investors work on the basis of trust. They're like, trust is their filter. Their network is their filter. It's not that they're blind, or their filter. The best filter on the planet is your network, and that's how they go about it.
I think those are some great advice here. Like, I mean, people do look at cold emails, but your network is your net worth. And, when you make an intro, you have this massive transference of trust, and everyone has 5-10 people they know. What I've also found is, like, oftentimes I'll reach out to other founders who took money from other investors, and I'll reach out and say, hey, you know what? I'm just back channeling to see what's it like working with XYZ investor, versus asking for an intro. They talk to you, they tell you all about the investor, they learn about your business, and at the end of the call, they're like, you know what, you have an interesting business. I'd be happy to make an intro. Like, that approach has also worked, is getting advice on what it's like taking money from XYZ investor, and then leveraging that to make the intro. Let's shift focus to founders looking to launch funds on the side. What is the ideal fund size for the first one? How do you get started, and how do you sort of attract LPs?
So I think historically, there was kind of like the standard line was that if you're a founder, you can't be a good investor, and you can't teach an old dog new tricks, right? And institutional investors are also quite a little averse to founders doing stuff on the side. It was like there was the time and attention clause. Oh, well, you're not really putting all the time that you need to. This is a full-time job, and you're giving short shrift to it. That is progressively changing. There are people who trust you, people who believe in you, and who can give you. So again, it goes back to the people like, it'll be super hard for you to just go to random, unless you are a celebrity. So there is this thing. So, and of course, Lloyd, you're a celebrity, you could do it, so unless you're Harry Stebbing or Lloyd Lobo, you can do it, but a lot of times, or you're a public company CEO, but a lot of times institutional investors, as long as those dollars get bigger and bigger. So, and of course, there is no hard and fast rule as to, is it a $10 million fund or a $20 million fund? But all these funds, they also come with, portfolio construction. So as it's easy to write a 10K check, or a 20K check, or a, 100K or 200K check, but it's really hard to, get millions of dollars in a hotly contested deal. So especially at kind of the seed or Series A. So that's why it has to work with the fund size and the thing. So I would say, look, a small fund in the tens of millions, or single-digit millions to tens of millions, which is doing seed and not leading rounds, easier to raise, assuming you are invited, assuming you're one of those founders who has access. Access is still important, but it's so many different layers, right? So if you are one of the sought after investor, you can get in. But if you want to raise if you want to raise a $500 million seed fund, then that's not going to happen, or $100 million. Then people will say, oh, who's your team? Are you full-time? How do you support those companies, et cetera, et cetera. So that's kind of the thing. And then also on the flip side, like later stages as well. So I think I think founders who are passionate about investing, I would urge them not to just think about a fund. I would urge them to think about different things that they could do. Have they done some angel investing? Let's try their hand at angel investing, right? And 20 to 50 checks and see how that's going. Maybe they do a rolling fund. Maybe they work with some engineers and get more involved in the companies. We have a model like that with a few founders that work with us. I'm happy to put you in touch with kind of our team there. And then see what's the best for them. I'll tell you that a lot of founders actually don't want to be full-time fund managers. They like investing for the ecosystem. They like what the founders really like. They like giving back. The great founders like giving back, and investing is just a way to give back. And so so I think that's the thing. So the nice thing is that there is no one right answer. I'd like to think we are the one right answer for all of the above, but right now they could work with their it could be the VC partners that they've worked with, and a lot of them actually do. The VCs will the founders will become scouts for them. Then they will have a fund with them. I'm not going to name them, but there are many founders who have like a fund, and their only LP in that fund is the VC fund that backed them. And so it's like people and trust.
Definitely. And AngelList also has made it easy, because you can launch a fund or a rolling fund on AngelList. They handle all the back office, and you can effectively raise from folks like yourself or friends and family to dabble a little bit in investing, as long as you have a good network and community. I want to take some questions over here that came through. Matt asks, what is the best way to invest your own money into a startup, via a separate investment company or directly, or a combination?
It's a very good question. Of course, there are many platforms now for investing. Yeah, and you mentioned AngelList. For management, there is Carta, there is Republic, there is a whole bunch of others, right? So you can use those. I think it's also now it's all democratized. You can invest in AngelList, you can invest in YC startups, you can invest in EF startups, you can invest in startups just on the web. So I think you can do this. I think it all goes back to like what your goals are. And by the way, I'm not recommending that any individual investor invests, but I'm just talking about kind of how founders want to do it. The issue, of course, is how do you construct that portfolio? So you need to have enough diversity in the portfolio, because most of these companies will not do well. But this is the power law, as Jeff Bezos likes to say. You will strike out, but on Grand Slam you don't make. It's not a 10-run or 4-run Grand Slam. It's like a it could be 1,000-run Grand Slam. So that's the thing, is like if you get the Uber, the Coinbase, the Instacart, it's a 1,000x.
What are your top tips for constructing that portfolio?
It's very hard. I mean, that's why it's not easy, right? It's how do you create the possibility of asymmetric returns, right? So that's one way in which venture is very different from real estate. Real estate or private equity. I mean, you're not going to, maybe you lose 50% of your money or you lose 30% of your money, but you're never going to lose 100% of your money. And you can never say never, but when you buy a house, you will recover some, assuming you're buying it with cash. But you're also not going to, in 3 to 5 years, you're not going to buy, if you're not going to make 10 times your money. You might make 2 times your money. And in venture, that's not the case, right? Most of maybe public equities have been different last 2 or 3 years, but historically that's the case in public equities. But venture capital, it's always a power law. It's not a Gaussian distribution, but only when it's done the right way, right? That's why you need to invest in seed. Of course, when you invest in Robinhood at $20 billion, of course, not to pick on Robinhood, we're lucky to be early investors there. Robinhood could go down in the public markets, right? You're not going to make 10 times your money investing at $20 billion. So that's the thing. But if you invested in Robinhood at $3.5 million, so then the question is, how do you create a bucket of high quality? And it's not just high quality founders, right? So a lot of people say, well, I just back the founders. Well, at the end of the day, it's not just founders, it's the markets, right? If you can, look at some of the most prominent founders, companies that came because of the thing, like a deal or a Hopin, or a Zoom, they're great companies, but they wouldn't have been, if COVID hadn't happened, those companies wouldn't have grown as big, as fast as they did, right? So it's just sometimes nobody can predict. So you need to just have diversity in your portfolio.
What do you think separates the good founders who are starting side funds from the ones that are mediocre? What are the key traits you see? Because you back a lot of these folks, and in many senses, folks like Jason Lemkin and Gary Tan had their roots there when you backed them, right? They were founders who were starting like a side fund, and then now it became full-fledged fund. What are the top traits of those people?
And I will say something very controversial here. At some point, a lot of people are looking at like, so, is somebody a really good investor? It's really, what? Nobody can tell if somebody is a good investor. There is no such thing as a good investor. There are good founders, and then the people who help, they're good builders. At the end of the day, it's value creation. It's like, can you be helpful to somebody? So I look for all those traits that you look for people otherwise. Is there positive energy? Are they uplifting? Are they building? Are they empathetic? Are they helpful? They are partners in the journey of the startups, right? So they're almost, so in some sense, the way I filter is all different types of founders and their mentors. They're the chairman of the board. They're the thought partners. They're the and they're the people that the founders call when they have a crisis over the weekend. And that's they're basically building the company. Of course. And that goes back to my philosophy of not chasing the hot, shiny thing,
What's your parting advice for founders looking to raise money for their startups in this market right now? How do they go about it?
Yeah, it's the same thing I was saying, find people who believe in you. Find long-term capital partners, find the appropriate capital partners, right? So don't find the hot money, but find your believers and find those who can support you, support you for the long term. And basically work with you. These could be, as you said, they could come from your network. They could come from people that you've heard really good things about. And then in all these things, everybody's telling me, Alex, this time it's different. It's not 1.0 here. It will never, they always say that, and in some sense, we are living in an extraordinary time. There's a little bit of mania. And maybe this time it's not different, right? So think of what you really need to build a high-performing organization. Put those, maybe capital is not a constraint, but maybe it should be. You can raise as much money, but how much money do you need to raise to build an enduring, amazing company? So as you know, if you're getting the best engineers and the best the product people just by offering the highest salaries, you probably don't have the best organization, right? So you need to find the missionaries. Just like you find missionaries for your employees, you need to find the missionaries for your investors.
One last parting question here. What are some of what are you reading right now? If you're into reading, or what are you listening to these days? What books, what podcasts?
Well, I loved your podcast. I just listened to I just listened to Jeff Lawson, and it was ironic. I listened to I read his book, reread his book again. So I think Jeff Lawson is a big inspiration for me, and I think I think if there is one overarching theme for the next 10 years, whether it's crypto or Web 2.0 or SaaS, I think it has to do with developers. So I think developers will be at the core of most of the innovation in the thing. And apart from that, I really love philosophy. So I've been reading Arthur Schopenhauer, and the world as will and representation, and it's kind of grounds a lot of the things that which we're chasing after. They like things, and it also kind of shows you how interconnected this is. So much of Arthur Schopenhauer was an inspiration for many of the leading thinkers that came after him, and then he got his inspiration in part from the Buddhist philosophy. So it's ironic. We like to say, oh well, this is Western thinking and this is Eastern, and it's ironic how interconnected all of it is. So yeah, and then I just love the Stoics. So I think the Stoics really, the startup journey is one of roller coasters. And I think it's only when you are, when you look at it from a Stoical viewpoint that you are like, yeah, you can't get success go to your head, and, just failure is part of the journey, the struggle is the journey. So.
Definitely. You learn a lot more from failure. Don't let rejection rule you. Let it fuel you. Alex, it's been a great pleasure. We're 5 minutes past the top of the hour. Wishing you happy holidays. Enjoy the holiday season. Thanks so much for joining us. And folks, we're closing out the final session of the year. We did over 100 sessions this year. And on Thursday, we have the Chief Operating Officer of Atlassian with us, talking about disruptive innovation, talking about transforming your company for exponential growth. Alex, have a wonderful holiday. Take care. Love and peace.
Thank you, Papa. Thank you for having me. Thank you for your community.